So we've now found the formula for aggregate expenditures for our imaginary economy, right? We found aggregate expenditures, which are C plus I plus G plus X minus IM. We found the formula for this was 300 plus 0.5y. And from there, we can plot against a 45-degree line, and we found our equilibrium. And in the imaginary economy, we were at equilibrium when our income was 600. So what I want to look at now is what would cause this aggregate expenditure function to shift and thereby change the equilibrium size of the economy. So when we talk about what is going to change aggregate expenditures, we're looking at that change in autonomous spending. And so let's recall all the things that changed autonomous consumption spending, investment spending, government spending, and net exports. Because anything that changes autonomous spending for any of those will shift the aggregate expenditure function and thereby change the equilibrium size of the economy. All right, so let's make a list here. Let's start with C. What would cause aggregate expenditures to increase? Well, if there's an increase in wealth, right, the stock market's doing well, then you're going to buy more goods and services, even if you have no income or regardless of your income. So an increase in wealth. That was the wealth effect. Then we had our real balance effect. And the real balance effect looked at a change in price. Remember, if prices went down, then that meant the amount that we have in our savings account will go further, so we don't have to save as much. And if we don't have to save as much, we can spend more now. So autonomous consumption increases when prices fall. Then we talked about a change in expectations. If consumers are more optimistic, then they're more likely to buy goods and services, regardless of the level of income. Let's try that again. Increase expectations. And the fourth thing that changed consumer spending was the age of durable goods. And if we were talking about what would increase autonomous consumption, the age of durable goods, those goods are going to have to get older. Okay, so increasing wealth, lowering prices, more optimistic consumers, and older durable goods will all shift the aggregate expenditure function upwards because they are increasing autonomous consumption. All right, let's talk investment spending. What would increase autonomous investment spending? Well, if interest rates went down, then businesses would be more likely to get loans and expand their location, buy new equipment. If there is an increase in the age of capital goods, that equipment gets old, it's got to be replaced. If there is a decrease in spare capacity, then they're going to increase investment spending. If there's an increase in their optimism, and if there is a decrease in the level of bureaucracy or red tape, all of those would increase in autonomous investment spending and thereby increase aggregate expenditures. All right, so that was C, that was I. All right, let's talk G. What would make government spending go up? Well, the government spending would go up if they're using fiscal policy to help stimulate the economy. All right, C, I, G, that leaves what? X minus IM. So when we talk about aggregate expenditures increasing, we're looking at what would make autonomous net exports go up. So what would increase autonomous net exports? Well, if foreign income went up, that would increase exports and thereby increase net exports, which would increase autonomous expenditures. Let's see, if prices in Canada went down, if prices in Canada went down, then other countries would buy our stuff because it's cheaper, so exports would go up. We'd buy more of our own stuff, so imports would go down, and net exports would go up. Maybe foreigners like Canadian goods more. And if foreigners like Canadian goods more, then exports will go up. And net exports will go up. And the last one that changes net exports and increases autonomous aggregate expenditures is if the Canadian dollar changes value, and it would need to depreciate. That would make Canadian goods cheaper for foreigners to buy, making exports go up. If the Canadian dollar depreciates, it becomes too expensive for Canadians to buy foreign goods, so imports go down, and all that makes net exports go up. So if you change any of these that we've listed here, this will change autonomous expenditures, and we've listed what will increase autonomous aggregate expenditures, and so will increase the equilibrium size of the economy. Well, so this brings us to a discussion about what we call the spending multiplier. So the spending multiplier tells us when we change that autonomous expenditures. Okay, so if we go back to our graph here. Here's our function for aggregate expenditures. Here's our 45-degree line. And so what we're looking at here is if we increase autonomous spending, so aggregate expenditure graph shifts up, then what kind of impact is that going to have on income? So what impact on income will that change in autonomous spending have? This is what we call the spending multiplier. So if you have a multiplier of 2, then that means however much you change autonomous spending, income will change by 2 times that amount. So for example, if government spending increases $100, then we're going to shift up that aggregate expenditure by $100, and that's going to change this equilibrium. Well, how much is income going to change? If our spending multiplier is 2, then $100 of government spending will increase national income by 2 times that 100, and the income, national income, will increase by $200. So government spends $100 to stimulate the economy grows by $200. So when we look at multipliers for different countries, you can see them here. Canada's multiplier is about 1.32. France, you can see a 1.16. Japan, 1.85. The US at 2.17. Okay? So we need to figure out where this multiplier comes from to help us understand why the US has a higher multiplier than Canada and why France has a lower one. So to calculate the multiplier, we take 1 over 1 minus MPE. When we do 1 over 1 minus MPE, remember that MPE, we can find that MPE because MPE is the slope of our aggregate expenditure function. So our aggregate expenditure function we've been working on is 300 plus 0.5 y, which means our MPE is 0.5. Okay. And so we can find the multiplier as 1 over 1 minus 0.5, which is 1 over 0.5, and 1 divided by 0.5 is 2. Now there are other ways to find the MPE. We can also find the MPE with this formula here. The marginal propensity to consume of disposable income times 1 minus the marginal tax rate minus the marginal propensity to import. So let's make a list of all the formulas we've come up with so far. All right, we found that C was equal to 5 plus 0.6y, and we found that savings was negative 65 plus 0.2y, and we found that tax was 60 plus 0.2y, and we found that exports was 100 and imports was 40 plus 0.1y. We found that investment spending was 75, government spending was 160. We found the marginal propensity to consume of disposable income was 0.75, and we found the marginal propensity to save of disposable income was 0.25. So we've been asking you as we've developed these formulas what each of them mean, and right now let's look at how we can get the marginal propensity to expend from these formulas. So the marginal propensity to expend can be found by taking the marginal propensity to consume of disposable income, 1 minus the marginal tax rate, minus MPM. Okay, so we have the marginal propensity to consume of disposable income is 0.75. We can find the marginal tax rate because our tax formula is 60 plus 0.2y, so here's the marginal tax rate of 0.2. And then we can find the marginal propensity to import because we have the import function, and the slope of it is 0.1. So we have 0.75 times 1 minus 0.2 minus 0.1. And so MPE in this example, we take 0.75 times 0.8 and we subtract 0.1 from all of that. So 0.75 times 0.8 gives you 0.6. 0.6 minus 0.1 is 0.5. And once you have your MPE of 0.5, you can find your multiplier with 1 over 1 minus MPE. And we found 1 over 1 minus 0.5 is 2. So once you get a multiplier, the multiplier tells you for every $1 increase in autonomous spending, then national income increases by whatever your multiplier is, in this case it's 2, by 2 times that. So government spending stimulates the economy with $100. National income increases 2 times that, $200 worth of growth in the economy. So let's go back to this idea of MPE and how you calculate it. Now, what if the MPE was a bigger number? So we found that if MPE is 0.5, the multiplier is 2. What if MPE is 0.75? Then the multiplier, 1 over 1 minus 0.75, which is 1 over 0.25, okay, 1 divided by 0.25, we get what? We get 4. So the bigger the MPE, the bigger the multiplier. So what would cause a country to have a bigger multiplier? Well, to have a bigger multiplier, it must have a bigger MPE, which then takes us back to the formula for how you calculate MPE. So notice MPE is the marginal propensity to consume of disposable income. when your people have income after taxes, how much of it do they spend? And then we multiply that times 1 minus the marginal tax rate. So if we increase the tax rate, if you have a country that pays more in taxes, then the marginal tax rate is higher, which makes this whole calculation smaller. So the higher the tax rate, the lower the MPE, and the less the multiplier. This should make sense, because if you have your income and you have to give more to the government, that gives less for you to spend, which means that's less money in another person's pocket to become their income, and they're not going to spend as much of that because they have to pay taxes, and that ripple effect that it has on the economy isn't as big. If we lower the tax rate, you get to keep more of your income as disposable income. You get to spend it on stuff, and that becomes someone else's income, and it has a bigger multiplier. We can also look at the level of imports. If we import more goods, then that's money leaving the country. So if we're buying goods that are predominantly from another country, then if the government tries to stimulate the economy by increasing autonomous spending, maybe the government is creating some jobs by building some infrastructure, then all that income you're making, you're spending, but you're spending on goods from another country, so it's not becoming someone else's income within this country, and it's not able to multiply. So when MPM goes up, we buy more foreign goods, or the marginal tax rate goes up, then the marginal propensity to expend will go down, and the multiplier will go down. So when we look at countries like France and the US, we see they have different multipliers. So the question is, what is happening with the level of taxes they pay, and what is happening with the amount that they import? Now, let's look at some application of this multiplier. Perhaps you've heard about the Canadian Action Plan. So the Canadian Action Plan goes back to 2010. And in 2010, the federal government decided to spend $60 billion to stimulate the economy. So the question is, how did they figure out $60 billion was the amount to spend? Well, according to the multiplier, for every $1 of autonomous spending, it's going to increase national income by how much? 1.32. Okay, so why would they spend $60 billion to stimulate the economy? Well, if they spend $60 billion of autonomous spending, then national income would increase by 1.32 times that. So 60 times 1.32 is $79.2 billion. Well, why does this matter? Well, the nominal GDP in 2010 was 1.58 trillion, or 1584 billion. And notice that if they could grow the economy 79.2 billion by spending 60 billion, well, 79.2 divided by 1584, if you do that calculation, 79.2 divided by 1584, you get 0.05, or 5%. So they found that they could grow the economy 5%, but they didn't have to spend 5% to do it. Because of that spending multiplier, the government could spend $60 and it would turn into $79.2 billion in terms of income. And the reason is that the government spends $60 billion paying people to build roads, build hospitals. That puts money in their pocket. They then use that money to go out to eat, to buy TVs, to buy cars. That puts income in somebody else's pocket, which that person uses to go out to eat and buy TVs and cars and so on, and it has that ripple effect. How much of a ripple effect it has depends on what our tax rate is and how much we import. So if the Canadian government spends $60 billion to stimulate the economy $79.2 billion, if we look at these multipliers, which country would require more government spending to get the same stimulus effect? Will we need the multiplier to be bigger or smaller? Well, $60 billion stimulated the economy $79.2 billion, 1.32. If we had a larger multiplier, say our multiplier was 2 instead, then $60 billion would become $120 billion. If your goal was to grow the economy 5%, then the higher the multiplier, the less the government has to spend to stimulate the economy, because the more the money they spend will multiply or ripple throughout. The lower your multiplier, the more the government would have to spend to stimulate the economy. If your multiplier is 1, then if you want to stimulate the economy $79.2 billion, you have to spend $79.2 billion. So how big the multiplier is really determines how much the government has to spend to stimulate the economy, and whether or not fiscal policy, using government spending to stimulate the economy, is even worthwhile. Because if the government has to pay the full amount to stimulate the economy, then it's not a very good deal. And it can be very costly since the government is going to have to bear the entire burden of that. The larger the multiplier, the better fiscal policy works.